Hello, everyone. Today we're breaking down the biggest illusion in America right now. The stock market is booming while everything else feels like it's falling apart. And the reason is not complicated. It's capital flows. Let's start with the spectacle on Capitol Hill. While victims sit behind the Attorney General waiting for justice, what's the headline defense from the administration? The Dow is over 50,000. The S&P is near 7,000. The Nasdaq is smashing records. That's the talking point. As if the stock market is a moral scoreboard. As if green candles erase red flags. Here's the truth. The stock market being high does not mean the economy is healthy. It means liquidity is abundant. That's it. And this disconnect didn't happen overnight. Go back to 2008. When the financial system nearly collapsed, the Federal Reserve stepped in with unprecedented liquidity, quantitative easing, near zero rates, backstopping banks. That moment changed everything. Before that, markets still had some relationship to fundamentals. Companies had to perform. Valuations had limits. Corrections happened when things got ridiculous. After 2008, a new doctrine emerged, the Fed put. If markets fall too far, liquidity appears. If corporations struggle, funding gets easier. If risk builds up, rates drop. And global capital understood the message. Then came 2020. Pandemic stimulus didn't just stabilize the system, it flooded it. Trillions of dollars injected into the economy. Treasury issuance exploded. The Fed expanded its balance sheet at historic speed. Money didn't just go to households, it went everywhere. Corporate balance sheets, private credit, equity markets, speculation. When you create that much liquidity, it has to land somewhere, and equities are the easiest landing zone. They're liquid, they're scalable, they're globally accessible. So while Main Street was struggling with supply chains, inflation, and housing costs, Wall Street was surfing a tidal wave of capital. Corporations refinanced at ultra-low rates. They deleveraged, they recapitalized, they bought back shares, they increased dividends. Buybacks matter here. When companies use cheap debt to repurchase their own stock, they reduce supply. Earnings per share rises even if actual growth is mediocre. Investors cheer, share prices rise. But who benefits? Shareholders. Not workers, not renters, not wage earners, shareholders. If you have a large portfolio, you felt it. If you're living paycheck to paycheck, you didn't. That's the disconnect. Now layer on global capital. Foreign investors view U.S. markets as the deepest, most liquid, most protected market in the world. So when trillions of new dollars entered circulation, global investors absorbed them at a premium and recycled them back into U.S. equities. It becomes a self-reinforcing loop. Dollar issuance, global demand, equity allocation, rising valuations. Meanwhile, sentiment surveys show the public feels worse than ever. Why? Because inflation compounds. Even if CPI says 2 to 3%, that's on top of the surge from 2021-2023. Prices don't reset downward, they compound upward. Shelter remains elevated. Food inflation persists. Insurance costs are up. Utilities are up. Services inflation is sticky. But the Dow at 50,000 becomes the headline. This is the psychological split. Financial asset holders feel fine. Wage earners feel squeezed. And the administration's strategy appears simple. If the market is green, the narrative is green. But that foundation is fragile. Because when markets detach from income growth, from productivity expansion, from broad-based job creation, they become liquidity-driven, not fundamentals-driven. Liquidity-driven markets are powerful, but they are not invincible. They depend on continued capital flows. And those flows are starting to rotate. We are seeing cracks, not collapse, cracks. Bond yields remain elevated. Private credit markets are under scrutiny. Regional banks still carry unrealized losses. Commercial real estate hasn't fully cleared. And yet equities float. Because there is still too much money searching for yield. It rotates. Tech down? Rotate to staples. Growth pressured? Rotate to value. Large caps wobble? Rotate to small caps. Rotation keeps the index stable. But rotation doesn't create real growth. It redistributes liquidity. That's why GDP feels sluggish while the S&P feels unstoppable. Real GDP barely clearing stall speed, consumption slowing, investment cautious. But the index pushes higher. It's capital concentration. Now let's talk about jobs. On paper, payrolls rose 130,000. Unemployment edged lower. Sounds fine. Until you revise prior numbers down by nearly 900,000 jobs. Until you realize average monthly growth last year was barely 15,000. Until you look under the hood. Healthcare, social assistance, temporary construction tied to data centers, manufacturing flat, retail flat, leisure flat. Data centers deserve special mention. Hyperscalers are committing hundreds of billions to AI infrastructure. That construction requires electricians, HVAC specialists, mechanical contractors. But those are project-based spikes, temporary, localized, capital-intensive. Once built, data centers employ relatively few workers. This is not the foundation of broad middle-class expansion. It's infrastructure for automation. Which leads to the next concern: AI disruption. Simultaneous product launches from major AI firms wiped nearly $1 trillion in sector valuations. Why? Because markets are trying to price in automation risk. If AI builds the next AI, if AI writes code, if AI replaces white-collar tasks, where do displaced workers go? Again, liquidity can buoy markets, but liquidity cannot manufacture broad-based wage growth. That's the tension building under the surface. Markets float, Main Street strains, sentiment erodes, and policymakers respond with index levels. That is not sustainable long-term. Before we move to part 2, where we break down inflation manipulation, deficit illusions, and why the bond market is the real battlefield, make sure you're subscribed, because in this environment, understanding capital flows is survival. Let's start with inflation, the number they celebrate and the number people actually feel. Headline CPI comes in around 2.4% year over year, core around 2.5%. Politicians smile, anchors cheer. The narrative becomes inflation defeated. But here's the structural issue. Those year-over-year comparisons are distorted. Data collection disruptions last year artificially lowered the base. When you adjust for that distortion, inflation is closer to 3% than 2%. That may not sound dramatic, but in a system already carrying elevated price levels, that extra 1% compounds hard. Shelter is still the largest contributor. Housing costs aren't falling meaningfully. Rent remains sticky. Mortgage rates remain elevated. Electricity is up over 6% year over year. Food inflation persists. Services inflation remains embedded. Energy is temporarily soft because global demand outside equities is weak. That's not strength, that's slowdown. When people say nothing feels cheaper, they're not imagining it. Prices ratcheted higher between 2021 and 2023 and never reset. Inflation slowing doesn't mean prices fall, it means they rise slower. That difference matters. Now combine that with wage growth that is not materially outpacing inflation, and you get real income compression. The stock market doesn't reflect that compression, but household budgets do. Next, let's talk about the deficit, because this is where things get politically clever. January's deficit narrowed relative to last year. Fiscal year-to-date numbers look slightly better. Headlines suggest improvement, but zoom out. We are still on track for nearly $2 trillion in annual red ink. The improvement isn't structural reform. It's revenue bump from tariffs, tax collections concentrated among high earners, and federal workforce cuts. 40% of Americans don't pay federal income tax because they don't earn enough. The top 1% pay roughly 40% of income taxes. That means stock market strength disproportionately boosts tax receipts. Asset gains, capital gains, higher tax receipts, temporary deficit relief. See the loop? Markets go up, revenue improves, narrative strengthens, markets go up. But if markets reverse, that revenue evaporates quickly. That's why the bond market matters more than the Dow. Bond yields reflect structural confidence. If investors demand higher yields to fund U.S. debt, financing costs rise across the system. Higher yields mean higher mortgage rates, higher corporate borrowing costs, higher government interest expense. Interest expense is already one of the fastest growing components of federal spending. This is where the illusion meets arithmetic. Now let's return to AI and tech rotation. When $1 trillion in market value disappears in days because AI firms release stronger than expected tools, that's not normal volatility. That's structural repricing of labor. Markets are beginning to process something uncomfortable. AI productivity gains may not translate to wage gains. If companies use AI to automate white-collar work, margins improve. Shareholders benefit, but employment growth narrows. We already saw job concentration in healthcare and temporary construction. That is not diversified labor expansion. That is sector concentration, and sector concentration increases fragility. Now think about capital rotation again. When large cap tech sells off, money rotates into value stocks. When growth compresses, money rotates into staples. When AI fears spike, money rotates into defensives. The index survives because liquidity remains abundant. But rotation does not solve structural weakness. It masks it. That's why sentiment surveys show unease despite record highs. People do not measure economic health by the NASDAQ. They measure it by rent, groceries, healthcare, childcare, and job stability. And here's the uncomfortable truth. You can have record indices and stagnating median wealth at the same time. Because wealth concentration drives markets, not participation rates. Retirement accounts help some Americans, but a significant portion of households hold minimal equity exposure. Asset inflation benefits asset holders. It does not automatically benefit wage earners. Now let's bring it full circle. The stock market is high because massive liquidity still exists. Global capital still views U.S. markets as the deepest pool. Buybacks reduce share supply. AI expectations drive multiples. There is no immediate alternative large enough to absorb the capital. That's it. Not because wages are surging, not because productivity is broad-based, not because household balance sheets are exploding upward, because money needs a home and equities are liquid. But here is the warning. Liquidity-driven markets remain stable until capital flows slow. What slows flows? Higher bond yields, dollar volatility, geopolitical shocks, credit events, private credit stress, energy spikes, policy missteps. We are seeing early pressure in several of those areas. Nothing has snapped yet, but tension is building. If yields remain elevated, equity multiples compress. If inflation reaccelerates, rate cuts stall. If AI accelerates job displacement faster than job creation, sentiment deteriorates. Markets can ignore sentiment for a long time. They cannot ignore funding conditions forever. That's the macro take. This is not a collapse call. It is not a panic signal. It is a structural observation. The stock market is elevated because liquidity is elevated. Main Street feels strained because real income growth is limited. Deficits are narrowing marginally but remain historically extreme. AI is disrupting valuation models. Capital rotation is masking fragility. And the bond market is the quiet battlefield underneath it all. If you want to understand where this goes next, stop watching the Dow. Start watching yields. Start watching capital flows. Start watching deficit financing conditions. Because when liquidity shifts, the illusion shifts with it. If you found this breakdown valuable, subscribe. Because in a liquidity-driven system, understanding the flow of money is more important than watching headlines. I'll see you in the next one.